The Kagiso July Purchasing Managers Index declined by almost 10 points to a two-year low of 44.2 index points on the back of prolonged strike activity in the manufacturing sector. We cross now to Cape Town, where Abdul Davids, head of research at Kagiso Asset Management, is standing by to give us more details on that report. Thanks so much, Abdul, for joining us this afternoon. So we've seen the PMI decline to a two-year low in July. It's been losing ground, and a decline this time round had certainly been anticipated, but falling back below the 50 mark, and that is the point that's really caught markets by surprise here. Just how much of a concern is it for you that we're sitting now at 44.2 points?
Yeah, thank you very much. It is a big concern for us. I think the consensus was looking at closer to 51 to 52, so a slight decline from last month's 53 point something. But I think what has exacerbated the decline has really been the situation on the strikes front. We've also seen the electricity price increases kicking on the 1st of July. So a confluence of factors driving the number substantially lower, and obviously lower than we expected as well. I think unfortunately a lot of those factors that drove it lower almost persisted throughout the month of July, and some of it is continued into the month of August as well. But clearly quite a negative surprise in terms of the number that we have seen today.
It also now sits significantly below the latest readings on the global PMI, but where we've been lagging, the reduction in global PMI indicators for a while. So to what extent do we look at this as an element of catch-up as well coming into effect here?
I think that is true, and we flagged that last month in terms of the numbers that we saw last month, that we saw consistent weakening for the last couple of months, most notably in new factory orders, and also in terms of what we call the leading indicator, new sales orders minus inventories, for example. This month that number is flat, so clearly there has been some catch-up in terms of, for example, going back to February, March, the Asian tsunami and events in Japan, for example, South Africa being a bit removed from that side of the world, clearly it was always going to impact us at some point. Now clearly in terms of quantifying those impacts, it's very difficult for us to do, but clearly there has been some impact, and obviously the catch-up that we have seen in terms of the July numbers as well. Concentration
now will shift to getting up and going once again, and we've seen the capacity utilization rate, which had been on an uptrend, see a decline now with all the strike activity. I mean, if we hone in on Sasol and its Synfuel facility, for one, operating at an 85% capacity as a result of stay away. Is it easy to ramp up once you've had that capacity come online? How has this dented your outlook moving forward?
Very good question. I think for different industries, it's obviously easier or more difficult to ramp up depending on the nature of the production processes. I think in Sasol's case, I think it typically takes up to 3 weeks for them to increase the production from the levels that they've lost from. So clearly it will continue to have an impact, and probably lingering impact going into the August numbers. Having said that, I think what we've also seen is that some industries are still in shutdown mode, given what we have seen in terms of most notably the electricity price increase. I think in today's papers they talk about the Exxaro ceasing production of zinc, for example, in South Africa. So clearly there has been some remnants of that continuing, and unfortunately probably continuing into the month of August as well.
Yeah.
So unfortunately the outlook, especially from an activity point of view, while we expect a rebound coming through in August, clearly because of the non-recurrence of the strike action that we have seen, especially in the first couple of weeks of July, it's unlikely that it will recover to above 50, for example, in August.
It's one thing production increasing or that capacity being enhanced moving down the line, when you've got to ask the question to cater to what demand exactly. And there's a worrying development bubbling in that when it comes to new sales orders in particular, the index averaged 60.1 index points during the first half of 2011, and we've seen that now down to 48.8 in July. So let's take a look at the kind of demand scenario we'd actually see this industry catering to.
That's exactly the point, and I think we see a slacking building up in the system as well. Unfortunately, the worrying trend that we're seeing right now is that demand has been soft, most notably from the mining sector, for example. And I think right now we're still in the midst of a gold mining strike as well. And given the gulf between what employers are offering and what the workers want in the gold mining sector in particular, I think that will probably continue for some time, unfortunately. And clearly that points to weaker demand from most notably the mining sector, but also from related sectors as well, going into July, August, and probably into September as well.
What's even glaring at this point, and it's certainly come as no surprise, we've had the jobs prospects in the factory sector remaining dire, with the employment index declining by 8.6 index points. What kind of impact do you see the current wage negotiations, that are playing themselves out, and the settlements being reached having on this scenario moving forward?
Unfortunately, quite a negative impact, unfortunately. I think what we have seen is that wage settlements, especially in the related industries, the paper and the chemical sectors, for example, multiples of inflation at the moment. So I think they settled at around 10%. So clearly in terms of those settlements, if your cost base is growing at more than CPI and your revenues are not growing at similar magnitudes, then clearly you need to cut costs somewhere. Unfortunately, what employers have tended to do is to rather retrench workers. So the workers that are obviously still on the payroll, they're getting an above inflation increase, but that is spread amongst fewer workers. Ideally, what you should have is a situation where you got wage increases increasing even above inflation, but it's somehow linked or pegged to your revenue line. And the best measure for doing that is through productivity enhancements or gains that you can see in terms of increased productivity. But unfortunately in South Africa, that is not a legacy that we have, and clearly there has been huge resistance from the unions to have any wage increases related to productivity.
When it comes to those input costs, though, at least one bright light has been the fact that we've seen declining trend on that front for the past consecutive 3 months. The PMI index also experienced a further decline this month. Is that sustainable as you see it?
Ironically, that's more linked to what I think you're referring to, the PMI price index, and that's more linked to, amongst other things, the currency as well. So we've seen a continued strengthening of the currency, so especially imported prices, that has continued to come down. Commodity prices, even the gold, for example, is at new highs. In rand terms, it's not up as much because the currency has strengthened somewhat. So clearly the price index of or the component of the PMI related to prices have been impacted by the currency, and obviously in a positive way as well. So for as long as the currency remains at these levels, you'll probably see that index remaining flat or even declining further as well.